The main difference between VTI and SPY lies in the underlying index they track. VTI is an exchange-traded fund that tracks the CRSP US Total Market Index, which encompasses a diverse range of cap sizes, from the smallest to the largest, and comprises over 4,000 stocks. This diversification makes VTI less volatile in the event of market fluctuations. In contrast, SPY tracks the S&P 500 Market Index, which focuses on the largest cap stocks in the market, with approximately 500 trading companies in the U.S., resulting in higher volatility due to the smaller number of stocks. In terms of cost, SPY has an estimated expense ratio of 0.09%, making it more expensive. The fee structure for SPY is currently at 0.1%, which is twice that of VTI. VTI, on the other hand, has an expense ratio of 0.03% and a cheaper fee structure, making it more appealing to passive index investors seeking lower investment costs. Although the expense ratio and fees are subject to change, VTI is currently the less costly option. When it comes to returns, SPY offers higher dividend returns, with a yield of 12.67% over the last 10 years. In comparison, VTI investors have received returns of 12.05%, which is slightly lower. However, it's worth noting that the difference in returns is less than 1% and is subject to change in the future. Despite their differences, VTI and SPY share some similarities. Both are exchange-traded funds with the same top holdings, including Microsoft, Amazon, Apple, and Alphabet. They also have the same minimal initial investment policy, which involves buying shares. Ultimately, the choice between VTI and SPY depends on individual preferences. While SPY's higher returns are attractive, VTI's low expense ratio and lower volatility make it a more appealing option. Considering these factors, VTI emerges as the better choice due to its low cost expense ratio and reduced volatility in the event